Hey there, my name is John Stevenson. Welcome to the Guarantee Retirement Guy Show. Today we're going to be talking about how annuities are taxed. So if you're wanting to purchase an annuity and you're wondering how am I going to be taxed, we're going to talk about exactly how this would be done. Okay. Sometimes you're not taxed at all. Sometimes it's very little. Sometimes it's a lot. Just depends. So let me share my screen because I want to show you what the taxes would be for different situations. Okay. All right. So if you're familiar with my channel, you'll notice I talk a lot about guarantees. I love annuities. Okay. I love the contractual guarantees that they give, and the payouts are huge. So if you're looking for taking a portion of your portfolio and you want to have a lot of lifetime income, or you want guarantees, you want high rates, then I'd love to help you. Okay, if you go to my website, johnstevenson.com, you will see all the rates. You'll see everything that's available. And then I'd love to help you purchase if that's what you're looking to do. So anyways, there is a link below this video if you want to book a call, or there's a link on my website. So I'm not going to try to push or try to hard sell you anything, but if you are looking to work with someone who's a financial fiduciary, someone who will show you everything and who is transparent, then I'd love to help you. So, all right, so let's look at my screen. We're looking at someone who is 67. They're putting $500,000 in. They're in California, and they're just a single male. Okay, if it's a joint payout, it's going to be a little bit lower, just depending on the ages of the spouses. Okay, so but based off of this, okay, let's just talk about taxes. Okay, and this is any funding. I mean, it doesn't matter. The income will never change. So you can do this with cash. You can do this with a Roth, with a traditional account, traditional IRA. It doesn't matter. Okay, the income will always be the same. So what we want to know is, what are the taxes going to be? Okay, and this is the income rider. I'll show you the SPIAs next, because those are taxed according to the exclusion ratio, which is different. Okay, so let's look at this. We will say, all right, and this is a single payout, immediate income, $500,000, $39,000 a year, forever. Okay, very simple. Okay, if they were to defer it, let's say to age 70, then the income, of course, will be higher. And of course, you can figure this out on my website and look at the calculators yourself. So you can see now we're getting like $50,000. So that's kind of nice. So let's just say this person wanted to defer for 3 years. Okay, so they want to defer for 3 years, and now let's talk about taxes. So I'm going to assume this is all cash. None of this is IRA money. Okay. And so based off of this, again, when you're looking at income annuities, don't focus so much on the growth, because you're not going to get a lot. Okay. You're going to get a ton of income, but not a lot of growth. Okay. These are not made for legacy. So I say this as a disclaimer, because a lot of people want both, and you can't have both. You got to set up separate accounts for that. So with these, you can see the contract value will last until you're like 80. Okay, and that's with 3% growth if you get it. You might get higher, might get lower. Okay, if you get lower and it's zero forever, which is pretty extreme, but let's say you did, then it only lasts like till you're 79. Okay, so either way though, the income is there forever, and you spend $500,000, this person's getting a pretty large pension. Okay, and by the time they're 96, 97, they're like $1.4 million in income. Pretty good. So that's why you buy it. You're buying it for the pension income. So let's take a look at this for taxes though. So at this point, they start taking income, and it's $510,000 of the balance. And the reason for that is because you got some rider charges. See the rider charges over here? These are income riders. The income rider gives you a lot of income, and you're paying for it, but and it's just coming out of the account value. Now, you don't have to pay an income rider fee, but if you don't want to, then your income is going to be like 30 to 40% less. So sometimes half. So it just depends on what you're looking for. If you're looking for highest income, I don't think the fee matters. So that's up to you. All right. So the annual withdrawals though, $51,000 guaranteed for life. Okay. And let's just say this is cash. So they put in $500,000, but there's only like little growth, like $510,000 in there. So what's going to happen? Well, with a non-qualified account, it's taxed on a LIFO basis. Last in, first out. Okay. So the last into this was interest. So that's going to be paid out first. So you start income, $51,000, $10,000 of it's going to be taxed. $41,000 is tax-free, because they got to give you back the premium, the original premium that you gave them, which if it's cash, you've already been taxed on it. Okay. So that is completely tax-free. Now, let's say on the next year, you've got a balance of $451,000, which of course is reflecting not really any growth that year. But you see, there's some years where it gets growth, some years it doesn't. If you get a little bit of growth, you're going to be taxed on it. So let's say it's like $5,000 worth of growth. Then you're going to be taxed on, you're going to be taxed on $5,000 and the $46,000 will be received tax-free. Okay, and this will continue. This cycle will continue, and you'll continue to be taxed on just whatever earnings are coming out of that, every single year that are part of that $51,000, and then the rest is tax-free. But it will get to a point, of course, where they will have given you back the entire $500,000 that you gave them. Okay, after that period, it's all taxable. It's all 100% taxable because now it's 100% earnings, benefit, 100% benefit from the company. Okay, those are seen as earnings and those are completely taxable for the rest of your life. So it's still not a bad option if you're looking to have lower taxable income in the first years of your contract. A lot of people love this. And I set these up all the time. So now let's look at a traditional IRA. This is very easy to figure out because we already know anything coming out of a 401k or TSP or 403b is going to go into an IRA. And it doesn't matter if you're taking income from those, if you're taking income from an IRA, it still comes out tax ordinary income. That's just how it works. So if it's from an IRA, then it's $51,000 a year and it's fully taxed. So it's very simple. There's not much to say about that, except that's just how it is. So the difference is you got an annuity contract backing it, so that income is guaranteed forever. So if you just had this in an IRA and you're taking out withdrawals, you'll be taxed until your IRA is dry, and then you're not taxed anymore. With this annuity, you're taxed even after the account is dry because it's still coming out of that bucket, that traditional IRA bucket, okay? If it's a Roth IRA, then it's completely tax-free. That's very simple to understand and talk about as well because anything that comes out of that bucket, even if it's backed by an annuity contract, is tax-free. And so I do have some people that will want to do this, but you just have to remember there are only certain carriers that will allow you to do a Roth conversion after purchasing. So if you want to do a Roth conversion before buying an annuity, especially if it's the highest payout, then you might want to consider that because I'm looking at here and none of these top ones actually support it. So I'm going down here. Now, American Equity does. They'll support partial and full Roth conversion. So that would be the better option if you're going to plan on doing that after purchasing the annuity. Okay. Let's see any others. Midland allows it as well. So Nationwide does, but it has to be a full conversion afterwards, which most people don't want to do that. They want to spread it out and do partials. So anyways, you got to keep that in mind when you're doing this and you're making the decision to purchase an annuity. And sometimes I will have people that are like interested in this, but most of the time they're like, no, I'm going to pay a huge amount of taxes right now. And my break-even age is somewhere in my 80s. I don't want to do it. And so I would say if you're just asking me what the most popular option is, the most popular option is just to buy it with your traditional account and have that lifetime income and have it come out of a traditional IRA. That's typically what people do. It's either that or a non-qualified one. I do get a few Roths here and there, but not a lot of people have their money in Roths, and so they're still converting. And so it is nice to be able to have that as well. One other thing that's nice about having this in an IRA, if you have it in an IRA, you're going to be subject to RMDs at some point, okay? If it's 73 or 75, you're going to be subject to RMDs. And the government's going to make you withdraw, whatever amount. Maybe it's 5%. What's nice about a lifetime income product is it satisfies those RMDs. Sometimes it'll satisfy the RMDs not only in that IRA that the annuity contract is in, but maybe some of the money in your other IRAs. That's nice too. So it could satisfy everything. But if you got a lot of money outside of it and other IRAs, then you'll have to satisfy the difference from those accounts. So that's how that works. Now let's talk about the exclusion ratio. This is just for SPIAs and DIAs. Those are the classic contracts where you give your money to the insurance company and they annuitize it for your life expectancy, the projection that they have of how long you're going to live. And they'll just basically spread out the payments. They'll say, all right, here's how much you're going to get. And based off of your life expectancy, this is exactly what your taxable amount is going to be every single month. And then here's what the tax-free amount is. Okay. They just spread it out. And I'm talking about non-qualified money. Okay. Cash. Okay. If it's an IRA or Roth, it's the same deal as this. Okay. But the difference with the SPIAs and DIAs is they will spread it out. Instead of just giving you all the earnings that you got the year before first, they just spread it out according to your life expectancy. Let me show you. And if you want to watch a video, I actually have a video where I go through the calculation. Just go on my YouTube channel, Guaranteed Retirement Guy, and look up exclusion ratio on my channel, and you will see my video about how this works in detail. Okay. All right. So let's go into SPIA calculator, and I'll show you real quick how this works. So we're going to put money in, same 500 grand. You just take out, make sure there's cash refund if something happens to you. Non-qualified money. So non-qualified is just cash. It's just anything that's already taxed. Okay. All right. So let's take a look at this. Again, the income here is probably not as high. It's not usually, it's a little bit lower. but you know exactly what it's going to be. So they just spread out and they're saying, all right, according to this, we think you're going to live, I don't know, they have their own mortality numbers, but probably somewhere in your 80s, okay? So based off of that, we're going to give you monthly income of $3,000.84.63 guaranteed for the rest of your life. And if you die early, we're going to give you a refund of whatever's not used. Now, since you're using taxed dollars, it's already taxed, then some of it's going to be received tax-free. And so for life, you're going to get $2,000 a month tax-free for life. But $1,000 a month will be taxable. Okay, so they consider that earnings. So what they're saying is based off of this, you're going to live maybe 30 years. Let's just say 30 years. So 30 years times $12,000 a year in taxable income. That's literally how they do it. So they're looking at that and say, well, we're paying you $12,000 a year in taxable, in earnings. It's $120,000 every decade. For 3 decades, that's $360,000 in earnings. So they're basically saying, all right, based off of your life expectancy, total earnings would be $360,000. And then, of course, we're giving you $2,000 a month back of your original premium, of course, and that is spread out over that time period as well. So that's how the exclusion ratio works. They basically just predetermine when they think you're going to die, and they will base your payments off of that. And that is what determines how much is going to be earnings, which is taxable, and how much is going to be tax-free. So in this case, if you're in the 15% tax bracket, you're going to be paying roughly $150 per month in taxes out of this monthly payment of $3,000. So there you go. Easy enough, right? Hope that helps. If you are looking to purchase an annuity, I'd love to help you. Okay. If you're looking for someone who's transparent, who will show you everything regardless of what they're being paid, I'd love to help you. There is a link below this video, goes directly to my calendar, and we'll get on a Zoom call and we can chat about your questions and what you're needing. Of course, you can go to my website, johnstevenson.com, and you can look at the calculators there. It gets a direct feed from all the carriers, so you can see everything real time, what it is, and that's updated every day. And then if you want to book a call, you can do that on my website as well. So I really appreciate you watching. I do hope this video is helpful. And if it is, make sure you like, subscribe, share, comment below if you got questions. I sincerely would love to help you. And we'll see you next time.